Family mode.
Hey everybody, Preston Bryn here with our Trader User Group free weekly roundup. This is for the upcoming or the past trading week, December 8th, 2017. Before I jump into the charts, just a quick commentary on what we've seen this past week. You know, the week, which you probably know, was up just a little bit for the week. I mean, the Dow was up about 40 basis points, 0.4%. NASDAQ, however, was down about 10 basis points. So for all practical purposes, it was flat. And the S&P was up 40 basis points. It actually made new all-time highs. But, you know, one of the things I'm seeing here, volatility, as we go into the end of December, volatility for 2017 is going to go down as the lowest average vol for the entire year on record. So we've had an extremely low vol all year long. Now, 2018, I don't believe is going to be like 2017, but more on that in another update for another week. But I've seen 2017, and for those of you that are following me on my weekly updates, probably know I've been saying buy the dip all damn year long. I know some of my friends, buddies, and hedge funds and other big traders um, have been trying to short any dip or shorting as we make new all-time highs, but they've been, you know, stopped out of that trade quite often. We've made so many all-time highs this year, it's really funny. Uh, the chart action and pricing has said buy the dip. It has never said start to go short. Now, if you're day trading, of course, you can take a counter trend move, but you know that's for a day trading trader. But for swing trades longer term, we have been a buy the dip all year long, and it served us very well in our secret trader. I'm going to be coming out with an offer for our secret trader in about another week. You guys should stay tuned for that. We're at 22 out of 22 right now on our trades for in the oil markets, really knocking the ball out of the park. And I'm going to open this up for everybody next year. So be ready for a holiday year-end special on that. But back to the commentary here real quick. I mean, we've had low interest rates, low inflation, a dovish Fed, low volatility, and full unemployment. Full employment at 4.1% is defined by the Fed. So, I mean, what could go wrong? Oh my goodness, famous last words, right? The other thing that I'm seeing in kind of a Machiavellian sort of way is the current beat versus miss statistics on U.S. economic data. They keep stats on everything now. And it shows that it's at the highest level in 4 years, meaning the beats, you know, the stat says it's going to come out at X and it comes out at X plus percent. So it actually beats the projection. The projections have been beating on a higher percentage basis in the past 4 years. And while this is all good, it does tend to soften any continued beats out of the market. In other words, it takes more and more to keep the markets at these elevated levels. And any miss tends to accelerate the downside reaction to the miss. Okay, so um, it's kind of a Machiavellian approach, but that's how it tends to work from my experience. So we've got market valuations now at 18 forward earnings. The PE ratio is at 18 on forward, not prior, but forward earnings, not trailing. And even if the tax cuts and the tax cut package, which looks like it may go through, it still keeps the valuations on a forward earnings basis at 17 and a half. So as the valuations are at these levels, risk tends to be higher and higher as these valuations go up. But the risk, of course, as you know, is to the downside. And in another interesting Machiavellian kind of thing that I find, typically Wall Street is early in the dance. You know, if you look at the history of IPOs and venture capital and companies that tend to rocket out of the gate and just really come on strong, the early players, the early adopters in the assets, even in the equity world, is Wall Street and those that are related to their Wall Street brethren, right? The big money players, hedge funds, and so forth. And they make all the money. And then by the time the asset has been valued fairly or even richly, then the retail trader comes in, which then, you know, who's selling to the retail trader? Most of the Wall Street pros, and then the markets fall. And the retail trader is left holding a dead rose. Well, what's really interesting, and I said another Machiavellian look, is Bitcoin. And if we look at the Bitcoin universe, and let's call it cryptocurrency, because Bitcoin is one of the biggest in the cryptocurrency universe. Right now, it hasn't been led by Wall Street. It's been led by the common retail trader. In fact, the estimates are 85 to 90% of all the volume in trading right now in Bitcoin, which is the biggest, is the retail trader. And now what I find interesting is the professional gang, you know, the Wall Street firms, the hedge funds, some of the bigger ones are just now starting to come into play here. And it's already reached these uh, extreme valuations in my mind on a near-term basis. So what I may find to be funny is Wall Street comes in and they start picking some of this stuff up, and then the retail trader sells it to them, and then they take it in the shorts, and they end up holding, a dozen dead roses. Nothing but thorns. I think longer term there's some play here, especially in the technology. But I just think right now it's pretty much elevated. Now we're seeing here the CBOE, they're set to launch their own Bitcoin futures on their platform this Sunday. And then that's going to be followed on the 18th by CME, which is the largest derivatives trading platform in the world. They're going to be launching their Bitcoin futures on the 18th. Now, all of these are going to be cash settled. Surprisingly, they're not going to be settled in Bitcoins. They're going to be cash settled. And the way they're going to go about doing it, you can lose 4 to 5% on it because they're going to average some various spot prices of Bitcoin to come up with a settled price. But it's going to be like the wild, wild west. And I think in a surprising way, now traders are going to be able to short Bitcoin rather than just simply going long. So it's going to add more of a two-sided market to it. So I think it's going to be very interesting when it comes out. But even with the bubble in Bitcoin, because I know everybody's talking about the bubble in Bitcoin, and it takes a long time to blow up a balloon, but all you got to do is pop it, and it doesn't deflate as slowly as it inflated, right? It just boom, it goes, and it's like helter skelter. Let go of the balloon, and it's just blowing out air all over the place, and it flies all over the room until it finally comes to a withering halt and falls to the ground. Well, Bitcoin could be like that before it starts to gain momentum again, but that's not the mother of all bubbles. It's kind of like the Philadelphia Shuffle, which I've used often in the markets. The Philadelphia Shuffle is a magician trick where he wants you to focus on his right hand, but the magic happens in the left hand. And you don't see it because your eyes are on the right hand. And then when the magic happens, you're just totally diverted. Well, the mother of all bubbles right now in the global markets is the over $10 trillion in global government bonds that are below zero. They're over 10.1 trillion. Now the U.S. is slowly and going to accelerate their reduction to the balance sheet in the U.S. And our bonds have never gone below 0%, but they have in Europe and over in Japan, even in Germany. Excuse me. The ECB is still buying about 60 billion euros a month right now. Japan is still in an active buying mode so that they can maintain their government bonds at 0%. ZIRP, zero interest rate policy is what they called it. So, they gave it that funny name last year or a couple of years ago. But what this has done for the U.S. market is created a very strong gravity effect on our interest rates, meaning it's keeping our interest rates low because the outside the U.S. owners of government bonds, we call them tourists, the tourists that are coming in and buying the government bonds in the U.S. market account for about a third of all the volume. Now, and they come over here because the interest rates are cheap. And there may be some arbitrage going on, but if you've got negative interest rates or zero interest rates and you're a big fund or you're a sovereign wealth fund, where are you going to park your money? You're going to park it in the U.S. But now, if these interest rates start going back up offshore of the U.S., what do you think is going to happen to the U.S. bond market? It's going to go down. And what do you think is going to then be the counter result of that? Higher interest rates. And then what does that start and lead into? Higher interest rates starts to put downward pressure on valuations of the equity class. And when equity valuations go down, what happens to equities? They start going down. And then because of the high margin debt right now by a lot of investors in the market, then all of a sudden you start getting margin calls and you start getting some more sell orders. And with the massive growth over the past 5 years of passive index funds, where these funds basically don't buy the best stock of the bunch, they just go out and invest in all stocks. I mean, I've told you this statistic over and over again. The Vanguard owns in one of their passive index funds over 5% ownership interest in 495 of the 500 S&P stocks. That is totally amazing. I mean, think about that. They have more than a 5% ownership stake in 495 of the 500 or 505 or whatever the exact number count is of the S&P 500. And what happens when there's a massive exit for the door? Because these passive index funds, because they've got to maintain those ratios of what they got to sell. So all good stocks and bad stocks are going to go down in a hurry. When you didn't have these passive index funds, then when you had a pullback, better stocks held up better than bad stocks. I mean, it makes logical sense. But what's going to be interesting is to see all good and bad going down when the tide shifts out. You know, for those that live in a bay, when the tide shifts out, the smell kind of goes up, right? It gets kind of nasty. So it's going to be really interesting to see. Now, early in 2018, I'll put my forecast out for you guys. For 2017, I was about a year ago, I forecasted a pullback in anywhere from 12 to about 17, 18 months. And that would put me towards the tail end of 2017 to about 3/4 into 2018. At least that's the way the chart seemed to indicate. I'm still on that track. I've said this year is going to be a buy the dip. I said we're probably got one more rise higher. The tax package goes through, they get infrastructure spending and so forth. We got a little bit of a rise higher. We go into Q4 earnings, which probably will be better than Q4 earnings of a year ago, year over year, quarter over quarter will be a little bit less. And then we get to quarter two or quarter one earnings, which they're going to be a lot less than year over year from Q1 of 2017 because the bar is now a lot higher. So we're going to have some really strong issues here in the market, and I think we're going to get a bigger pullback. Remember, we haven't had a 3% pullback all year. Unbelievable. We've set a record there as well, or a drop in price. And we've seen the markets and vol being at these all-time lows, lowest in history, as I said, really sets the stage for larger downside risk. Okay. So that's kind of what I'm looking at as we jump into the trading week this week. Now, if you look at the chart here, as you can see, this is a daily chart of the S&P 500 E-mini futures. All right. And it's just in this channel, buy the dip, buy the dip. Only one time during the entire year did we move south of the channel. We didn't have too far of an excursion from the top to the bottom of the channel. In fact, the top of the channel is roughly around 2480. The bottom of the channel is roughly 2415. So you're looking at, what are you looking at? 65 points roughly. And that happened over the course of almost 3 weeks. So it was not like a huge move down. It was just kind of a steady stream with just 1 or 2 big days. But outside of that, buying immediately came in and took it back up. So looking at this daily chart, I don't see very many big red candles on here. You could probably count them on one hand for the entire year. Okay. Now, as we come into the end of the year, let me just take some of the things off the screen here just to make it a little bit easier for you to see. So I'm going to get everything off the screen and I'm going to leave just the Fibonacci nodes on here. Okay. And let's just kind of put it like this. So now you can see the volume over price here. So these represent fairly strong buyer versus seller, where the buyers have won out support underneath the market. You can see we've got a little bit right here around the 2630 area. We've got a big chunk of it around the 2550 area. And then we got a big chunk sitting here right on a fib node of 2465. And notice the fib nodes, by the way. These fib nodes are key because I've had them on my screen for over a year and a half now. These fib nodes go all the way back to the highs the key pivot high on 2015 in the summer months of 2015, and then in the February months of 2016. Those are the key pivot points. And by defining these, we've been able to look at and project possible support and resistance points, in addition to typical other technical indicators and pivot points and price levels. And you can see 2.61 takes us up to about 2670. Okay, and we're almost there right now. And then I think we're going to run into some issues just a little bit. You can see down here there is no bearish divergence. That still suggests on this daily chart that any pullback is still going to be bought. Okay, and if we zoom in on this and just kind of get a little bit closer here, you can see in this area here there is absolutely no sense. Any dip is just, it doesn't last. And if we do have a dip, it's just slow and steady. So volatility actually can come down during this dip, right? Excuse me. And you can see where the 2.38 fib node held up as tremendous resistance, for almost the entire month of November. And then we finally broke out for good on the 24th of November. And then boom, we're coming into December. And one other stat, I think I went over it last week with you guys, but it basically says that anytime we go into December the 1st, where the markets have been up 10% by December 1st, then on average, December will finish up 2.5%, 80% of the time. And that, if you were to project that out from our December 1st lows, right, which would put us right around right here, right at that point, right there. We actually had a low right there around 2600 or so, would put us up around 2705, something like that. And it's just above our fib extension here. Now that's the mean, the average, and it's happened 80% of the time. The month of December traditionally is a very strong time anyway. I remember I told you 2017 is going to go down as the lowest vol on record. And volatility tends to peak and spike in the months of January, August, and October, generally. But it also tends to trough or be the lowest in July and December. So December, I think we should go out on a nice note. The last week in December, first week in January tend to be a sideways downward pattern because we're going to be experiencing low trading volume again. But this is kind of what we're looking at. And if I take this to a swing trading time frame, let's say 2 hours, which is a good swing trading time frame, and then I put all my indicators back on the screen again. There is that upsloping trend line or channel. You can see here that the projection that I'm showing here, I was having our folks get long down in this area down here. I'm projecting here sometime over the next week, taking us up to around 2675 area, something like that. Okay. Now we've still got some things that can upset the apple cart next week. We do have the Feds coming together on the Tuesday, the 12th, and Wednesday, the 13th, of which on the 13th, Janet Yellen, and we call her finally Aunt B, she's going to give us their rate hike because the odds are pretty much baked in. The prices right now that we're going to have a rate hike on the 13th. And then markets expect 25 basis points, so it'll take us to 1.25 to 1.50 for the rates. So that's going to be on the 13th. Then the 14th, we get retail numbers, which will be a big key for the holiday buying season, which I think is going to be very strong. And the retailers have had a strong bump up in November into December, but I'm thinking about shorting them going into the end of December. I think January could be that big run up in retail stocks. I think is worth shorting near term in the end of year going into January. Okay. And then also on Thursday, in addition to our Wednesday rate hike, we're probably going to get out of the Fed. Thursday, we get the Bank of England for Great Britain, and then we get the ECB interest rate decision. So next week is going to be big for bonds and currencies. We're going to see those things kind of bouncing around a pretty good bit. Now, as long as they do what's expected, the markets aren't going to react too heavily. You may see some initial spikes on those specific days, but typically after a day or two, it comes right back to where the price was to begin with. But this is kind of what I'm looking at right here near term for the markets. All right. Now, if I come back to the daily chart and show you China, because China is driving a lot of the metals, industrial metals, you can see what's kind of spooked the market just a little bit. China, just like the US, has been in an upward move, but lately it's been coming unglued. We had this huge, excuse me, move higher, and now we've come unglued and we're back down to this area here. So China is trying to clear back this tracking ETF ASHR, is trying to move back up, but I think it's going to roll up and then roll back down. That could have a tendency to pull back down oil and some of the other metals, industrial metals and things like that, especially copper. But we got to watch and see. This thing I'm watching very closely. Meanwhile, on the transport perspective, the Dow Jones transports on this daily chart here. Well, let me find it. That's the wrong one. I clicked is right next to it. I clicked the wrong one. Right here. Transports are up fairly high. Look at that. We made new all-time highs in the transports on December the 4th. Just, 5 days ago, 6 days ago, 5 days ago. It's really not that long ago that we made all-time high or 2017 highs as we go into the end of the year. That's bullish for the market. So like I said, markets are still in a bullish mode right now. And if we look at NASDAQ futures, which has been on a tear, it's been the strongest index for the year because of technology. We're off the highs, but not by much, right? I think it's due to have a little bit of a pullback too. I think as we go into the last week of the year, I think you'll see this thing pull back a little bit more than, say, the other stocks or the other indexes. So that's kind of what I'm looking at here, guys. All in all, we've had a great year this year. We've had 21 out of 21 trades successful, or 22 actually. We just closed another one this past week for a winner in oil. And like I said, I'm going to come out with a holiday offer here for you guys. Just 1 month of following us in oil. You can pay for your annual subscription. We haven't had a loss yet. So now we're doing better than I thought. I thought we would have had probably 2 out of 10 losses for every 10 trades. But the way we manage risk, we'd still be net up fairly nicely. But we haven't had one yet. And given the volatility in oil, it's really interesting. So, if we come over here and we'll get into the oil markets in a second. But speaking of volatility, 9.58 on the VIX. All right, now that's a 30-day out view. If you look at a week or 2 week out, we're under 8% volatility. I mean, it's extremely low. So the trade that a lot of big hedge funds are doing right now is they're shorting vol. They're going out to the futures market. They're going out on the term structure, 90 days, and they're selling volatility. And they're hedging it with short-term long calls. It's a good trade. It's been a great trade for the past 2 or 3 years. At some point, it's not going to be a great trade. You don't know when that point's going to be. And being short vol, you better be hedged, because if there is a black swan event, you're going to be underwater big time with short vol. Okay, unless you've got it hedged with long short-term VIX calls. For our secret trader members and for those that signed up for our option masters, we're gonna go over some very interesting ways to trade volatility, like that example right there, in upcoming sessions on our option masters. We're still talking about risk management right now. We're going to be covering position sizing this coming Thursday evening. And then the first week of next year, we're going to go into building your trading plan, and then we're going to go into the strategies. So, and the option Greek. So if you're not part of that option masters, you certainly want to jump into it. So that's kind of where we are there. And then with bonds have just had a lot of very volatile days. I mean, look at these big moves here. We've moved down, all the way down, all the way up, all the way down, all the way up, coming back down again. I mean, that's just, we're trading within a range. And until we break out of this range, it's going to continue to be very volatile. Basically, the range is from about 154 to 151. Okay, that's kind of the range that we've been in. And we don't stay in the middle very long. We tend to shoot up, and then we tend to shoot down, and we go right through it. So it's it's been a good day trading model for those that like to trade bond futures. But longer term, it can be very perilous holding bonds as it goes through these wild swings. Remember, it's $1,000 a point for every full handle that the bonds move, and a handle is like from 151 to 152, right? So it can be quite hairy here. We're still holding above the 2017 price, but that's kind of where I'm looking at for the bond market right now. So interest rates are still very benign in the U.S. markets. I think that's going to start to change as we get into 2018, probably through Q1 into going into the early summer months. Okay. And the other thing that we've done is high yield debt, as measured by the ETF HYG, right? We had this high yield debt play where we were trading this to the downside here, and then it's had a counter trend move, and then I think it's going to roll back over again. And high yield debt tends to correlate with the equity benchmark indexes. When they get out of whack, you want to believe high yield debt a little bit better because the debt market is a little bit more accurate and it's less prone to irrational exuberance. Although you could probably argue that now in the bond market with interest rates as low as they are with full employment. But this thing, if this rolls over, it could be the canary in the coal mine for the equity market. So our group, we're watching this very closely. Then, of course, we got equities, and we've taken some profits out of the British pound. I think longer term, the pound is going to go up even more. There's the channel. We were getting long the pound down in this area here, but the width of the channel suggests it's very choppy. So selling towards the top of the channel and buying towards the bottom third of the channel have been the way to go. Almost like looking at a Donchian channel or a Keltner channel, where you're buying towards the bottom and you're selling around the top, or you're holding on and just hedging your long position around the top. You can see we're almost flat dab in the middle of the channel right now. I think it may pull back a little bit and then it's probably going to take back off again. I said when the British pound was down here in the mid 120s, that in about 3 years it's going to be back up in the low 40s, 140s. And this is a train ride you want to be on. It's going to be bumpy. Seats aren't going to be very comfortable, but I think there's going to be good money in it. Okay. And we're just trading that with futures, and then we're going to probably do some more interesting things with it, or options on FXB, as well as jumping into the futures market. Now, in the metals market, gold is doing what I said it was going to do. All right. It was just reading the charts and looking at this. I said it was probably going to roll over. This colored zone here is right around the 1300 plus or minus 3 or 4 points. I said if we clear this and hold it, then I'm going to shift my stance to long. We couldn't do it here. We clearly couldn't do it here. Once it rolled over, I said to all our members that gold is a very technical trade. It follows the technical charts very well. And I said the next big key moment is not necessarily breaking the 50 EMA, but breaking the 200 EMA. You can see over here with the 200 EMA where it cannot get enough momentum to escape the 200 EMA. But picking up shorts around that makes sense. So right here as we blew down and we did not have a retest here like we had over here, then you can see just how fast it moved down. I said the next level was going to be around the 1250 area. And that's where we are right now. Okay. Now, I think we're going to get some consolidation at this area. Remember, the markets already have priced in a rate hike. So what the markets are looking for next Wednesday, December 13th, is when Aunt B, aka Janet Yellen, or is that Janet Yellen, aka Aunt B? I get them confused. But Yellen's going to belly up to the podium and she's going to, probably take her congratulatory turn, because I think she's been a fairly good Fed chairman. I mean, I like her as much as I bust on her, but she's done a really good job. She's very dovish, however, but that's kind of kept the market in check, probably a little bit more so than I would have liked, but be that as it may, that's what she's done. So she's going to belly up to the bar and what everybody wants to know, or belly up to the podium rather, and she's going to talk about where the markets are going to, how the Feds are going to interpret the markets next year. And there'll be a lot of questions on if they'll say, Madam Chair, if Trump's tax package really takes hold and the markets start to go and you start to see inflation move up, what area are you going to look at to determine you're on record as saying there's going to be 3 rate hikes, which the market is only forecasting 2. Do you see that changing to 4? And then I promise you, she's going to give them an answer, and you're not going to interpret what that answer means. You're not going to be able to figure it out. She's going to talk about transitory issues. She's going to be wording it in such a way that you cannot figure out what's white and what's black, what's dark and what's white. It's just that's the way she answers the question. She didn't want to set off a tsunami of a downward move. However, price action being what it is, it will interpret it, and it will move in one direction or the other. Gold is going to be subject to that press conference. If she is more hawkish, you're going to see gold come down to this next zone here. In fact, that's kind of where I think it's probably going to go, down around the 1200 area. Now, I do believe 2018 gold is going to end the year higher than where it is now. But right now, I think we still have more downside on gold and silver, by the way. Oil, let's look at oil. 22 out of 22, guys, on our oil trade. And this goes all the way back to right here. Let me just put it on to show you guys. We started our oil program right here. We rode it all the way up, and then we did these channels up and down, and then we've taken it and we moved it all the way up here. So our program, as you can see, works in sideways markets. It works in bullish markets. It works in bearish markets. It works in very choppy markets like we had in this area here in January, February of the year. And then it works in extremely bullish markets. Okay. So we've got, I believe, a fairly good oil program. Again, nothing's guaranteed for 100%. Anybody that tells you that, they should be shot, or I would run from them. That's what our records have done so far. Doesn't mean we're going to maintain it, but we run our risk models based on running about 8 to 10, right? 80% wins, 20% losses. So this is where we've had this huge run up here on the OPEC news. They're cutting production and all that, so forth, blah, blah, blah. And then we're having a little bit of a pullback here. And now we just got these, you can see the extensions off the lows here, right here. If I take it down to a 2-hour chart, and the nice thing about oil, you need to be able to trade options on futures. So if you've got a 401k account, you can't do this, right? You've got to have a cash account. Now, one of the really cool things that I'm going to be doing next year is I've set up a cash account of about $7,000, and then one for $25,000, and one for about $100,000. And we're going to be trading oil in each one of those accounts. So you'll be able to participate with small amounts and just play and watch how we do, right? Let me just take this off the screen here. And you'll be able to play along. So now you can see here in this fib node, I've got a retracement here, and we're sitting right on the 0.236 retracement at 57.33. The common retracement is 50%, right around 56.81. Now, oil, like gold, tends to move on key levels, key fib nodes, and key price levels. So this suggests that we could possibly pull back a little bit more, consolidate, and then make another run higher, possibly up to 58. 58 is a key resistance level. If we bust through that, we're going to be moving up to the 60 level fairly quickly. All right, in oil. I do believe oil is going to be bullish next year, but we're going to be wide range bound bullish, if that makes sense. But we're going to be continuing our trades and the way we've done this, and I expect good things out of next year as well. Okay, we're also in gasoline, and we're trading UGA, Uniform Golf Apple, is our ETF of choice for gas. And you can see on this 2-hour chart how it's just porpoising down, right? And each down move basically does not give us any divergences to the upside, which suggests a little bit more of a downside move. And that's kind of what we've got. We roll up, and then the selling comes in, and we sell the rallies, and we roll down, then we rally up, sell the rally, we roll down. Now we've had a fairly extended rally to the upside. There's going to be a little bit of a term of a consolidation here, and I think we may rally up a little bit more, and then we're going to go into a consolidation down. Why? Because November and December tend to be very strong for gasoline, and then February and March are very strong for gas as we prep for the springtime driving season. So there's just a lot of opportunities in this as well in the gasoline market. All right, everybody, that's kind of where we're sitting right now. I hope you guys have a great weekend. I will see our members this Sunday night. We'll go through some interesting possible trades for the upcoming week. We'll take a look at the new oil trade we just put on. And by the way, our weekly roundup, we're going to take a holiday the last week of the year and the first week of New Year. Our trader use group shuts down for 2 weeks just to clear the heads. I recommend as a trader, everybody should get away from the markets at least a couple of weeks to, kind of approach it. And the best way to do it is at calendar year end. Volumes are low. Trading is pretty much wrapped up, and then we're kicking off a new calendar year. All right, everybody, have a great weekend, and I will see our members Sunday night. Take care, folks. Ciao.